No one in the United States is hiring. According to the latest statistics from the US government, the hiring rate dropped yet again, falling to just above June's shocking low. It's so low, we haven't seen this rate of hiring since the early 2010s. During the Great Not Recession itself, the hiring rate wouldn't be this weak until July of 2008. This is exactly why the U.S. economy is in bad shape, and it can only get worse so long as this continues forward. But the government also said job openings rose, and that's what gets reported everywhere. One of the least reliable statistics there is, and that just means I get to pull out my chart and illustrate one more time how many times job openings have done this before, which means absolutely nothing. The real takeaway is always hiring. And according to the JOLTs data, that continues to erode and deteriorate. While there may have been a small pickup in the rate during the summer, it wasn't a material one. With October's update sinking sharply back to the lows, that's more confirmation that yes, the economy was in trouble during the summer and it didn't end in September. It goes along with the income data, which is indicating the same thing, the more than normal slowing. Not to mention the early results coming in from this past week of holiday shopping. The Black Friday Cyber Week seasonal kickoff kicked off poorly, which makes sense in an economy where workers know, at the very least, no one is hiring. Of course, that raises the question why businesses aren't loading up on employees to begin with. With interest rates falling, quote-unquote stimulus everywhere, the ubiquitous narrative that everything is starting to pick back up again, why aren't employers acting like they actually believe it? Sentiment is meaningless until you actually act on it. As long as the labor market continues to weaken like this, sentiment won't stay positive for very long. Just ask the Europeans. Why else do you think the carry trade continues to unwind? The dollar is wrecking other currencies around the world, and bond yields are tumbling all over again. Well, we'll start with Black Friday and the results, the initial results that are coming in from this holiday kickoff, or the kickoff to the holiday season. According to Bloomberg, fewer Americans shopped during Thanksgiving weekend this year, a sign that consumers remain selective about spending, and that's putting it kindly. An estimated 197 million people shopped from Thanksgiving to Cyber Monday, at least according to an estimate from the National Retail Federation and Prosper Insights and Analytics. This year's figure, which includes both in-store and online shoppers, is 1.7% lower than last year's record of 200.4 million, lower than last year. However, there were promising signs, at least for brick and mortar retailers. An estimated 126 million shopped in person throughout the weekend, 3.8% higher than last year. But the tally of online shoppers reportedly declined 7.4% to 124.3 million, which just says that brick and mortar traditional retailers finally got their stuff together and realized that it was about discounting and prices that keeps people coming in. Many people had turned to online shopping because that was the only place to save money. Now that there's a price war between the old and the new, so to speak, not only does that change the consumer calculus as far as where they're shopping, it also suggests everything about the state of the real economy as well as consumer inflation or disinflation. But years of high inflation and interest rates, not really so much interest rates, have made consumers choosy. They're increasingly prioritizing essentials and only buying products on sale, disinflation, while delaying bigger purchases, including those that need financing. But that's not why they're delaying these big ticket purchases. The choosy consumer is all about incomes and jobs, or as the case that we're going to go over here today, lack of jobs. Hiring has fallen way off, and it is not coming back, which it should. If everyone was optimistic about the future, companies would be loading up. After all, they've been slowing down and hiring fewer and fewer workers for quite some time already. So if the economy was about to take off, they would need to staff up in order to take advantage of it. But instead, more estimates on Black Friday and the goods economy, the state of the consumer. According to Salesforce, U.S. Cyber Monday sales totaled $12.8 billion, just 2% year over year higher, while global online sales rose 3% year over year to $49.7 billion. Now, there is an argument that Cyber Monday, like Black Friday itself, is no longer important. Now it's all about the week of Black Friday and the weekend heading into Cyber Monday. But these are not really good comparisons, as we just went over in the previous article. These figures came in lower than Salesforce's initial estimates that Cyber Monday would drive $13.5 billion in U.S. online sales and $51 billion in global online sales. In total, Salesforce data indicates Cyber Week garnered $76 billion in U.S. online sales, representing 7% year-over-year growth, as well as $314.9 billion in global online sales, up 6% year-over-year. Those don't include price changes, and 6% for online outlets in a holiday period, not all that robust. So the initial indications that we got from the all-important Christmas shopping season are consistent with everything that we're seeing in the labor market. The difference this year isn't price changes. Consumers have lost purchasing power. The difference this year is the labor market has been downgraded. And while we're here looking at the economy that was, on December 11th, next week, Jim Rickards and I are going to look forward at what the monetary system could be and how that might relate to a much better economic future. So we're going to discuss what the monetary system could be and maybe even what it should be. And we have some different ideas about what all that means, including we're going to talk about how we might actually get from here to there, which is an important part of the discussion too. So if you're interested in talking about monetary systems and shifting from where we are to where we need to go, join us next Wednesday, December 11th. There's a link in the description to sign up for it. This all comes back to incomes, labor market, everything. The economic health of any system is really about earned income. That's the basis of everything. That's the most fundamental aspect of it all. And what we've seen from more government data, including the latest statistics from the Bureau of Economic Analysis on personal income and spending, stuff that came out last week, personal income has itself weakened substantially during the same period in question. Nominal personal income, first of all, they were revised lower, $100 billion lower for just up to September. Really, it was during the summertime. The BEA decided that the income that they thought, the income growth that they thought, which was pretty anemic to begin with, was even more anemic than originally estimated. And even with a rebound in October, which is, one-time fluctuations, we see that all the time. There's one back in May just a couple months ago. Even with the October rebound, nominal incomes over the last 6 months up to and including October were only up 1.7%, which is about where it was, 1.7%, the 6-month change in September before the revisions. The revisions now have nominal incomes down to 1.2%, which means when you get all of this together, nominal incomes are growing by less than 2% on a 6-month basis for the last 4 months. Basically, the summertime income slowed down into what is a danger zone. We see nominal incomes that are rising at less than a 2% 6-month rate. That suggests major problems, which is everything that we're talking about here, from Black Friday shopping to the lack of hiring among U.S. businesses and U.S. employers. In real terms, same thing. Real personal income revised down by $100 billion because if you've got top line growth, the nominal terms that gets revised lower, you're going to have the same thing in real terms. Real personal income excluding transfer receipts, which is private income that's generated from the private economy. There was a small gain in October too, but go back to April. April, which was initially estimated as a small increase, is now thought to have been a larger loss, which means that there was a transition in the labor market in incomes right in April. Again, we keep coming back to that same inflection point all the time in all these different places. March, April, and heading on into the late spring and summer. And so more data, more evidence and corroboration from real income as well as nominal income that the stumble into summertime began before summertime and that it continued after summertime into the fall. So as far as real incomes are concerned, there was a rebound in May, as I mentioned, but then the 4 straight months after that, which were basically flat before October rebounded again, but even including October, from February through October, real personal income excluding transfer receipts only increased by 0.9%. So that's adjusting for prices. So you've got nominal slowdown across the real economy and the labor market, plus in real terms, not really making all of that gap up from the last couple of years. It's a recipe for growing problems. And that's why, despite the fact that sentiment may be rising because of rate cuts or the new administration or whatever the reason, whatever the case may be, sentiment may be up a little bit, not all that much, but it hasn't translated and isn't translating into action in the labor market in terms of hiring and everything else. And that includes job openings. So what the government reported, the Bureau of Labor Statistics today, was JOLTs, job openings in the labor turnover survey. And job openings, that's the one that everyone pays attention to. That's the one that everybody follows because it's supposed to be a proxy for the demand for labor in the economy. If companies need workers, they're going to have to advertise for them. It seems simple and straightforward, except the data is not simple, nor is it straightforward. It is highly unreliable, which I'll get to in just a second. According to the latest numbers, though, job openings increased to 7.74 million in the month of October. Keep in mind, these are for October. The payroll report that's coming out this Friday is for November. So JOLTS is just catching up to where the payrolls were last month. So job openings at 7.74 million, that's up about 400,000 from the 7.37 million downward revised in the month of September. And of course, any time that the job openings number increases in any single month period, which it does quite frequently, you hear all of the mainstream stories and articles come out about how strong the labor market is, even though the trend continues to go down lower and lower and lower. The 1 month changes get everyone going when it's the trend what matters. I mean, here's just a headline. U.S. job openings pick up to 7.7 million as labor demand steadies. And you cannot make that determination from one single monthly data point, especially in job openings. It was hardly the only one. This one comes from investing.com. The U.S. Bureau of Labor Statistics has released the latest figures for their JOLTS job openings, a key measure of job vacancies across the country. The recent data indicates a surge in job openings, with the actual numbers standing at 7.744 million. This figure significantly surpasses the forecasted number of 7.51 million, indicating a stronger than expected labor market. This increase suggests a robust job market with a growing number of available positions, reflecting positively on the overall economy, and all of that is just complete nonsense. One monthly increase in job openings means absolutely nothing. Just look at the number of times the same thing has happened over the last couple of years, and the trend continues to get lower and lower anyway. Forget about it. I mean, we're not even factoring in the revisions, but we also need to keep in mind that even if job openings did increase in October, and that isn't just another statistical fluctuation, it is still meaningless. Job openings is the least reliable statistic that's out there. Here's an observation on that from Observer.com. Justin Marcus is a professional recruiter and the CEO and co-founder of the accounting and financial recruitment platform Big Four Talent. When it comes to hiring and recruiting, he's seen it all. Quote, "When I started with a Fortune 500 recruitment company, which I won't name, there were people there that encouraged posting positions that were not totally real. With more than 10 years of experience in the field," he said, "ghost jobs and spam jobs, or jobs that don't actually exist, have increased." Stacy Standish, a press representative at the Bureau of Labor Statistics, told Observer that job openings data is collected directly from establishments and must conform to 3 standards. The position has to, quote, "exist," it could start within 30 days, and the company has to be actively recruiting for it. Data for the report is collected on a voluntary basis from a collection of sampled establishments, according to the BLS. Ghost jobs and spam jobs muddy the data collection and make it unclear just how robust the job market is. Ghost jobs and dummy jobs, whatever you want to call them, they don't really control for them. Sometimes ghost jobs actually conform to those 3 criteria that the BLS has set out. So we're getting double counting, we're getting fake jobs, we're getting all sorts of stuff in the job openings figure. That means, at the very least, that number is unreliable. And you could see how it has been increasing, you can see how it has become increasingly unreliable for over a decade. More and more job openings soar during the upturns in the economy, which just means that it doesn't mean that labor market demand has gone up. It just means that companies it's an easier, cheaper way to do a whole bunch of things that have nothing to do with demand for work. So while job openings was up during the month of October, the hiring rate was not. Remember, the hiring rate fell in June to a shocking low. Well, that's been revised since then. It's actually been revised lower. Somehow October almost matched it. There was a little bit of an increase in July and August and September in terms of hiring, but that was just more fluctuations within the continuing downward trend. And then October comes in, it's just barely 5.3 million, which is not a whole lot more than June's 5.25 million. That is a hiring rate that's equal to 2014. As you can see, the first half of the 2010s, back when the labor market was so incredibly weak, it led to all the negative consequences that we're still trying to deal with today. It compares basically with the bottom of the Great Not Recession and the inability of the U.S. economy and really the global economy to get out of it. That's where hiring is today. And if you're comparing to the downturn itself into the Great Recession, the Great Not Recession, the first half, we wouldn't see a hiring rate below 2% like we have here in October until July of 2008. More than halfway into it, basically heading into the worst parts of it. Even going back further, during the dot-com recession, the hiring rate never got this low. The dot-com recession, nor during the jobless recovery, which followed after it. So we're seeing exceptionally low levels of hiring. That doesn't suggest that that many people are claiming this is a red-hot economy that's cooling down into something more sustainable. That's the position of the Federal Reserve, and because that's the position of the Federal Reserve, that's the position of everyone in the financial media and for the vast majority of the public as well. But that's not what the hiring rate suggests. What it suggests is that companies are taking proactive steps to control their costs, which they would only do when they're not optimistic about the future, when they're pressured on both their top and bottom lines, and they don't feel like they need to add more workers. In many ways, they're taking other steps to control costs too, as we've seen other labor market data where hours are being trimmed and even some layoffs, according to the household survey, the rise in the unemployment rate, the decrease in the participation rate. All of it, it's combined into, especially when you consider the lack of income growth over the summertime, all of it together suggests exactly what we see from the weak Black Friday kickoff. Now, we've had this hiring freeze, this lack of hiring for quite some time, really going back to last fall. And by all indications from all over the spectrum, and just starting with the JOLTs data, it hasn't gotten any better, and quite a lot of it suggests that it continues to get worse. So we see that in Black Friday, Cyber Monday, Cyber Week, the holiday shopping season start, which comes in much weaker than had been anticipated when the anticipation expectations were already dim to begin with. Nobody was expecting a whole lot from this Christmas shopping season. Many retailers were just hoping to just get enough to keep everything going for another season. And even with these diminished expectations, it's coming in weak. That's because the labor market isn't there, hiring isn't there, incomes have not kept up in terms of past price pressures, nominal incomes are slowing down, which confirms that the labor market is becoming an increasing problem, that consumers already know all about it. That's still the ultimate fundamental case here. It's in everything that we've been talking about. It's a consistent case from top to bottom, from Black Friday shopping to the lack of hiring and everything else in between. It's the economy on the downswing. It's not a red-hot system that is just cooling down to a sustainable advance from here. It is the downside to the supply shock that has more downside to go. One more cyclical aspect to all of this, the banking system. Whether Europe, US, or even China, banks don't want to lend. Talked about that in the video link below. As always, thank you very much for joining me. Check out Eurodollar University's webinar next Wednesday, the 11th, link in the description. Huge thanks to Eurodollar University members and subscribers, and until next time, take care.